Time now for Options Corner. Joining us for a deeper look at the chart is Rick Ducat, lead market technician. All right, so let's dive into this one, Rick. What are the trends that you're paying attention to on this chart for Qualcomm?
Semiconductor stocks have been kind of the strongest of the strong for the most part. You can see the SMH ETF widely outperforming not only the tech sector but also the SPX. Then you have Qualcomm down here, only up about 4% during the past year versus the SMH, which is up 42%. If you were to look at Qualcomm against some of the big names in this field, once again, it doesn't fare very well against the names like Broadcom, AMD, Intel, Nvidia. All of them are up, a great deal more than this. And when you look at the semiconductor sector, a little more specifically, there's some very clear winners and losers. Some of the winners are the storage space. Micron, Seagate, Western Digital, these companies that make computer memory are doing extremely well. Then you have these companies here, Nvidia, AMD, these companies are CPU and GPU makers, so computer chips. And then we also have AMAT, KLAC, like the makers of the equipment. Then the industrial and wireless companies like Qualcomm and Texas Instruments, those are the ones that are really doing worse. So not all computer chips are created equal in terms of stock purposes here. It's kind of a very different field. So when we look at Qualcomm more specifically, we can see here 175 was an old resistance area that was important here because it was where price topped out several times. Then way down the road, it happened once more. Now, yesterday, we broke through that line once again. 153 looks supportive here based on some recent lows. If we were to look at our RSI and moving average studies, we held on yesterday at the 21-day EMA right around 172.45. Momentum also took a big hit here. We saw our green trend line broken, but we remain above that 50 midline here. Finally, if we were to look at our expected move here for the November 21st expiration, it comes in at about plus or minus 9% or so. A lot of technical indicators line up here on the downside, our linear regression line, our long-term moving average, our point of control for volume profile. Around 160 seems like a key downside area.
All right, thank you, Rick. That is the Duke of Data himself, Rick Ducat, with a look at the chart for Qualcomm. Now to take us through an example trade, we've got Tom White, senior options contributor and co-host of Fast Market. So, Tom, what's the approach you would take for an example trade for Qualcomm, given the context that Rick just gave about its performance overall, and when you think about the setup into earnings today?
Yeah, these legacy chip makers are underperforming. We've seen that. Rick mentioned a couple, Texas Instruments, Qualcomm. It's still up about 12% so far this year, but it has pulled back about 15% from those highs that we saw after that announcement where they're going to start competing in the AI data center space. So that gave the stock a lift, but it's pulled back pretty sharply from those levels. So I looked at a strategy. If you think this thing's going to rebound, maybe the bar's a little bit low. We've talked about all these stocks in the tech space where the bar's high. Well, this is one that the bar's actually low. It's underperformed. So I looked at a strategy. If you think the stock's going to go higher, this will take advantage of it. And you're using implied volatility levels between the different option series to take advantage of that. Going out to the November 14th weekly cycle, 9 days to expiration, we're going to buy the slightly in the money 172.5 strike call. Stock looks like it's going to open up just below 174. And then in the near term, November 7th weekly options that expire in just a couple days here, we're going to sell the 185 strike call. So a bullish $12.50 wide call diagonal to the upside. The option market pricing at about a plus or minus $10 move in the stock. So this aligns with that move up to the 185 strike because that's where you want it to go. Now, you're going to pay roughly about a 520 debit on that. That's going to be your risk. A $12.50 wide call diagonal, you're only paying 520 for. So you're buying it at a discount. That's because you're buying about a 60% implied volatility level on aggregate, selling about 100% on aggregate in those near-term 185 strike calls. The idea here is the stock moves above the 175 level. Anything above that level is going to be profitability. You want it to go at or near 185, but at the same time, anything above that 175 level is going to be profitability. And if you're more bearish, it's about the strategy. Do a put diagonal if you think the stock's going to fall.
All right. Thank you so much for that example trade there, Tom. Appreciate it.